The question on everybody's mind is, can I pick the funds that'll beat the market in the next year or two? Short answer, no. As I covered in another video, even though stock prices aren't necessarily correct, no one can consistently predict the direction in which they're wrong. Today, we're going to take a look together at what this means in the world of active fund managers and why it's virtually impossible to pick a winning fund manager ahead of time. As investors, we're always trying to find the best fund managers out there that'll give us the best bang for our buck. This is true for large pension funds, endowments, and individuals like you and me. Typically, we start our search by looking at which fund managers performed best in the last 5 or 10 years. By doing this, we assume that we're separating the wheat from the chaff. Problem is, this doesn't work. This presumes that the fund managers that beat the market in the past will continue to beat it in the future. But when we take a look at the data, it just isn't the case. To start with, there's a survivorship problem. Of all the funds available to choose from today, only about half of them will still be around in 15 years. I've linked a great paper about mutual fund survivorship by finance researcher Mark Carhart on the blog post below, if you'd like to know more. What's more, this is still true even if you only pick from the top performers. It turns out that when you rank funds based on the past 3 or 5 year performance, then analyze the performance of the top 25% of those funds over the next years, what you'll find is that they don't even perform any better than the funds in any of the lower quartiles. This means that past performance doesn't predict how well a fund will do in the future. Sounds familiar? Now, if you think the big pension and endowment funds get better results thanks to their high-priced consultants, guess again. Sunil Wahal, a professor at Arizona State University, conducted a study of thousands of large pension and endowment funds. He looked at their hiring and firing decisions when it came to their managers. What he found is that the managers that were typically hired following a strong 3-year performance didn't perform any better than the market in the following years. To make matters worse, if the big pension and endowment funds had stayed with the fund managers that they had fired, they would have performed better than the newly hired fund managers. So, the next time you see the disclaimer at the bottom of any fund performance report that says, past performance is no guarantee of future results, don't ignore it. If you're set on doing it yourself, I've linked to my colleague Dan Bortolotti's model portfolios in the blog post. Do you think you could beat the market? Comment below and let me know what your strategies are when picking funds for your portfolio. I'd love to have a good debate about it. Don't forget to like this video and subscribe to work with me as we look into investing topics together.